We're just getting some important news out of the UK. So we have the unemployment change. Actually, if you look at that, it's 181,000. Now, what I'm most interested in is actually the weekly earnings. This is basically wages. And if you strip out the bonuses, they're a little bit lower than expected. So 2.1% instead of 2.2% that we had back in July. So you can see the immediate market reaction, pound at 132.82. Now, this is important because yesterday, and let me bring you over to my Bloomberg chart. I know I showed this yesterday, but actually you can't really talk about inflation per se without talking about wage growth. You can't really talk about wage growth without talking about inflation. And this is a story that's emerging. So yesterday, inflation was at 2.9%. So that was higher than expected. And it was also near that 3% kind of level, which means that Mark Carney may have to write to the Chancellor. Whereas wage growth is actually not growing as fast, which could possibly mean that consumers feel a lot more cheated than they were, I guess, a year and a half ago. Still with us is Stephen Macklow-Smith. He's head of Europe Equity Strategy at JPMorgan Asset Management. Stephen, if you look at wage growth, unemployment figures compared to inflation, is it just ugly for the UK consumer?
Clearly, real incomes are under pressure in the UK. You can see that in the numbers. And I think that's behind a lot of the political discourse that you've seen in the last month and indeed since the election about pressure on public sector wages and pressure indeed to raise those. And we saw some headlines on that yesterday. So, yes, I mean, it looks as if the consumer has been under pressure. In the second half of last year, the impact of any slowdown seems to have been mitigated by an increase in consumer debt. But I think that there is an increasing amount of rhetoric about the need to raise wages.
All right. So what I'm trying to get my head around, so the problem is that for British workers, it's the lowest jobless rate, right, in 4 decades. So 40 years. Yeah. So it's very tight. But at the same time, it isn't enough to maintain their standard of living. So what does it mean for the BOE? How does Mark Carney wake up and look at these figures? Well,
my sense about the BOE is that if they feel that inflation is only the product of sterling weakness and sterling has been weaker against the euro over the summer, then they would be less concerned. I think they would be more concerned if they felt that domestic inflationary pressure was really accumulating. But we talk about what Mark Carney may think, but the MPC's views are as important. And we know that the MPC is fairly split on the future direction of monetary policy. They went from being very, very dovish to being much more balanced in their assessment. So I think that there is definitely a watching brief there.